Good evening, Hillman Talk. Welcome to Slay Student Loan Debt 101. My name is Natalie Jean-Baptiste. I'm a bankruptcy attorney, adjunct law professor, and student debt relief advocate. I wiped out six figures of my own student loan debt, and I have been on a mission to liberate people from student debt ever since. I'm grateful and excited for the opportunity to teach here at Hillman. And with that, let's get into lesson two. Before I get into tonight's topic, I just want to give you an overview of the course. And Last week we covered student loan fundamentals. This week we're going to be discussing repayment options. In week three, we'll look at loan forgiveness. In week four, we'll discuss delinquency and default. And last but not least, we'll look at bankruptcy options in week five. Please save the date Wednesday, March 12th, where I will be doing a live Q&A. So I will answer your questions live here on TikTok. In tonight's lesson, we're going to discuss repayment options. So this is a overview of what we're going to discuss tonight. Is first we'll look at different strategies for repayment. Then I'll discuss the fixed repayment plans. Then I'll go over the income-driven repayment plans. Then I'll talk about the loan simulator tool on the FSA website, the studentaid.gov website. And then I'll talk about resources and next steps and how we can work together in the future. When it comes to repayment, there are three main strategies for getting out of your student loan debt. One is the payoff strategy, which is pay the debt off in full as quickly as possible. The next one is IDR or income driven repayment or forgiveness options. So you pay the minimum required and you pursue forgiveness if you're eligible. The next one is lifer, meaning you're in it for life and you're making the minimum payments until death do you part. So the payoff strategy is suitable for the borrowers with low loan balances or a high income relative to their balance. So these are for people who have the means to realistically be able to pay the loan off in full, right? So your options include making lump sum payments when you come into extra money. For example, taking your tax refund and sending it to your lender to bring the balance down, um, or making more than the required amount, pay more than the required amount, where you are making maybe double the payments or adding any extra income, regardless of whatever the payment plan is or the monthly payment. You also have the option of refinancing to get a lower interest rate. I really caution against this when we're talking about federal student loans, because if you refinance the loan with a private company, you lose a lot of the benefits like loan forgiveness or income driven repayment. So you want to be very mindful when you're thinking about this option. And if you stand to save a lot of money and you know that realistically you can get out of the debt quickly, and you're not worried about job security or health or anything, then fine, go ahead and refinance. But otherwise, just keep a federal loan a federal loan. Next, we have the pursue forgiveness strategy. So this is where you're paying the minimum required and you're pursuing forgiveness, and your goal is to either get public service loan forgiveness after 10 years or do one of the income driven repayment plans where you will get forgiveness after 20 or 25 years of payments. So this is for borrowers with high loan balances or a low to moderate income compared to their debt. So again, making the minimum payments under IDR until you're eligible for forgiveness. Making extra payments is not recommended if your ultimate goal is forgiveness, because it doesn't matter if the balance is 100,000 or 500,000. If you're eligible for forgiveness, the entire remaining balance will be forgiven. So you will not get cool points for making extra payments. That's just a waste of your money. The third strategy is for those of you who are doing life. meaning that you have so much debt that there's no realistic option for you to pursue forgiveness or a standard payment. So, you make the minimum payments truthfully until you pass away. Just note that federal student loans are discharged automatically upon death, so your family is not going to be on the hook. If you can't afford the payments, you can also request a forbearance or deferment until you run out of that option. Usually, lifers are great candidates for bankruptcy and to be able to eliminate the debt so that you don't have to live with it for the rest of your life. Now let's talk about fixed repayment plans. So there are three main payment plans available. The first is the standard payment, and that's where you're going to pay a fixed amount and you're going to pay the same amount, and it's going to be paying off the debt within 10 years or 30 years if you're talking about a consolidation loan. The next is a graduated payment, and this is where the payments start off low and then it increases every 2 years. And again, the debt has to be paid in full within 10 years if it's a regular loan, or 30 years if we're talking about consolidation loans. The last option is an extended plan. And to qualify for this plan, you must have more than $30,000 in outstanding direct loans or more than 30,000 in FFEL loans. And the payments can be fixed or graduated and will ensure that your loans are paid off within 25 years. Next, we have income driven repayment plans, and there are four main plans. The first one is Saving on a Valuable Education, or SAVE, which is on its way out the door because the Trump administration will likely do away with it if the Supreme Court doesn't. The next is Pay as You Earn, or PayE, and I'll go into those details in a bit. The next one is Income Based Repayment, and I'll go into how that works as well, along with income contingent repayments. So the SAVE plan, as I mentioned, it was a very good option. It was based on 10% of the discretionary income, and the percentage of the discretionary income that was the percentage of income that was excluded from the calculation was higher. So it was a really great plan that was introduced under the Biden administration. But like I said, it's on the chopping block, so there's really no need for me to get into the details. Um, Next, we have the Pay as You Earn plan. And to be eligible for this plan, you have to have new loans after October 1st of 2007. And here you will pay 10% of your discretionary income, but never more than what you would pay under a 10-year standard plan. The IBR plan is similar, where you will pay either 10 or 15% of your discretionary income depending on when you borrowed the loan. And again, this IBR plan is also sort of tied to the litigation, because some of the provisions were the same as SAVE. So some of those are not quite, I don't know if it's going to survive. So right now, the ones that are highlighted in blue, the PayE plan and ICR plan, those are the ones that you can sign up for right now. Likely, if you sign up for SAVE, you're in a SAVE forbearance where you don't have to pay and the interest should not be accruing. Make sure you log into your servicer's website to make sure that you don't see any increase in your balance, because you should not be incurring any interest while you're in the SAVE forbearance. But again, just start planning because the SAVE plan is going to be eliminated. So you will be able to either sign up for PayE or the ICR. So the income contingent repayment is where you pay the lesser of 20% of your discretionary income, or the fixed payment over 12 years, like a 12-year fixed payment. Okay, I'm going to next talk about the discretionary income formula and how they come up with your monthly payment. Okay, so the federal government's definition of discretionary income is whatever you earn above 150% of the federal poverty line for your family size and state. So for a single person in most of the states except for Alaska and Hawaii, the 150% number is $23,475. So, for example, if you make 50,000, your discretionary income is 26,525, and your monthly payment is capped at $331. So here you can see the math of how it's calculated. So you take 50,000 and you subtract $23,475, and that amount is equivalent to 150% of the federal poverty line. So then you are left with a discretionary income of $26,525. You take 15% of that, you're about at $3,978.75, and then you divide it by 12 to come up with the monthly payment. So you can take your income and you do the math yourself based on your family size to figure out what your monthly payment would be under the income driven repayment options. And this is a chart of the 2025 poverty guidelines. So I have the poverty guideline number there and then the 150% number that they use to calculate your discretionary income. And next, we just have a chart of it's just a summary of the different income repayment options. So you can do a side by side comparison and refer to it later, depending on which income based repayment option you sign up for. Next, I want to talk about the loan simulator. If you're undecided about which option is best for you, you can go to studentaid.gov/loan simulator. Once you go to the main page, you can look for the loan simulator. So where you would log in and it pulls your loan information, and you can click on whichever option you'd like. The best one to click on is I want to find the best student loan repayment strategy. So once you put that in, it's going to show you the standard plan, the extended plan, the graduated plan. It's going to show you the income driven repayment options that are available to you. So based on your goals and your circumstances, you can come up with a strategy. So, and you can play around with it, like put in different income, put in the different scenarios. Let's say you're planning to start a family, like how what would your payment be if it were a household of four versus a household of two, stuff like that. So this is a great tool for you to take a look at what your options are. Okay. Um, Next, this is a list of different links that you can use to figure out what's going on. So studentaid.gov is the go-to where you are going to look at any of the information related to federal student loans. If you go to the Save Action page, you'll see the updates on what's going on with Save and the court action and the result of that. You can also look at the forms library where you can look at the forms for applying for the different income based repayment options or even the cancellation applications. And I'll get into that in future lessons, but this is a great resource as well. And like I mentioned before, the loan simulator tool, a great tool to use to figure out your next move. Another great resource is studentloanborrowerassistance.org. And last but not least, the Debtors Union, debtcollective.org. They have a lot of great information, webinars, resources for student loan borrowers. Okay. Just a quick recap of the services I offer. I help you stop creditor harassment, negotiate settlements on your debts. I help with document preparation, like the loan forgiveness applications, the IDR applications. And of course, I handle bankruptcy matters from preparing the main papers to the pleadings to file for adversary proceedings. If you'd like more information about, your particular situation, or you want to discuss your particular situation with me, just visit my website at slaystudentloandebt.com and book a free discovery call. And here's my contact information. Please send me an email if you would like a copy of this slide deck. My email address is listed there. And of course, just a disclaimer, I am an attorney, but I'm not your attorney. So the information provided to you today is for educational purposes only and should not be construed as legal advice. An attorney-client relationship is not created by your attendance. And thank you so much again for being here. Thank you, Hillman Talk, for this opportunity. I'm so grateful to have a new tribe of student loan slayers, and I look forward to seeing you all next week. And like I said, if you have questions, email me. If you want a copy of this deck, please email me. Have a great evening. I'll talk to you guys soon.